Good evening, ladies and gentlemen. We are going to start the session shortly.
Hello, Suraj.
Yes, he's not open.
Yeah, start my video.
Yes, it can start.
Just see. Have you started? Yeah, Suraj, good afternoon. This is Manoj here. Good afternoon, guys. Welcome to this webinar that we usually do every month. That would be precisely for the rollover data that we have on the derivative side. So I'll just run you through the PPT wherein we have accumulated certain data which holds key importance, especially to drive or to understand what the flow of the market, especially your indices and stock, along with sectors might be in the next fortnight or maybe the series for this June. Now, first thing first, this presentation typically would be we will first go with the explanation and then we'll have a questionnaire maybe 30-40 minutes from there. So once we are done with the presentation, please let us know the questions that we have either through chat or through this medium. So I hope everyone can hear me loud and clear. So I'll just start. Guys, before we go with the presentation, just a couple of things which I'd like to share here. The most important thing that we see in an index ideally is, especially on Nifty, if I have to see, would be the amount of participation that the people have into it. So in simple terms, we call it as open interest. So we are trying to portray what the participation in the indices, your Nifty and Bank Nifty might be, and how it might let us know what the trend might be in the coming days. So the first thing first, if you remember last time when we had this monthly rollover conference call, the Nifty open interest was at a good 85 lakhs, which is seen here. And the explanation, yeah. So just give me 1 second here. Yeah, I guess there was some technical glitch. Sorry for that. So I hope the screen is visible now, and this would go primarily with the rollover analysis that I just explained. So guys, if you remember last month was the first time when we started this, and we primarily started with a comparison to what the net positions of the traders and FIs they have into the index, especially on Nifty. So simple comparison is we literally go with the quantum of position just to know how this series of June might pan in. Needless to say, June would be a big series. The expiry for the monthly June would be on 30th. So it's a good 35-day month. So a big series with the futures and option can yield good returns. So the purpose here is to understand where at least the first fortnight or maybe couple of weeks or the monthly view might go in. So as I said, generally what we do is the first thing is to simply compare the position with what the June series have started. So if you see, we have simply mentioned here that the June series for Nifty Futures open interest is around 112 lakhs versus what we saw when we started the May series at 85 lakhs. Now, what it simply says is there are two reasons why we would see an increment in the position that the traders or the participants they take into the indices. One is obviously when there is a trend, but I'm afraid if you see the last at least 5 to 8 hour session, the Nifty has not really been in a trend. We are seeing a range bound session wherein a good 400 to 500 odd point swing is seen at least on 2 to 3 days on a weekly basis. So interestingly, what we have found out is obviously there is a good 150 to 180 odd stocks in to the FNO segment, and the amount of stock futures that get rolled from May to June is called the market wide open interest. So this time, that is when we started the series of June, excuse me, the open interest, the net value of the stock future that has been rolled from May to June is at 1.7 lakh crores. Now, ideally, when we started the May series, it was higher by almost 20 more lakhs. So it was almost 1.9 odd lakh crores. So what it says that the position in the stock futures is less. And second, the amount of Nifty futures position which has been taken into the next contract is high. So this usually happens when there is hedge position, because I guess since the month of April, we know that the FIs have been on a selling spree, needless to say, on the cash market. And the amount of Nifty, if you remember last expiry, that is a May expiry, was closer to 17,200. And yesterday it was almost at 16,180. So a good 1,000 odd points, which is roughly 6% in terms of the Nifty index, has been taken out by literally selling that we have seen. The good part is the bank Nifty has seen a fall of only 3%. So we believe there is a good outperformance happening from the banking stock, especially the bank Nifty. So Nifty futures, I guess from Friday onwards, that is the last Friday to expiry, there was good amount of rollovers that happened, and we believe that 16,050 to 16,100, these are the levels where this net amount of 112 lakhs position that we have for the June series is built up. So a simple way to trade this is that we expect the Nifty might take a support at least level of 16,000 to 16,100, and there is a good possibility that we might inch towards a 16,800. Now, as I said, when we give a view, a positional view on the index, the first reason is increased participation. So 85 lakhs in the May series has surged all the way to 112 odd lakhs. So we believe this net addition of 25-30 lakhs, which has happened, this increment that has happened, it has happened more at a level of 16,100, which might act as a pivot for this weekly expiry, which is a 2nd June, and we might inch towards a 16,400 or 500. So first thing first, the incremental addition that we have gives us a positive bias, because obviously the Nifty has gone up more than a 350 odd points. If you remember, expiry, the low was a good 15,900, and we are almost at 16,350 as of today. Second is this point which we usually say. Now there is a good chance that post 16,400, the reason why I'm saying this level is the accumulation of the call sellers, which is called as call writers, the accumulation of the call sellers into this series and some into the May series are more or less towards 16,400 strike. So that happens to be a pivot. So 16,400 would be a strike beyond which the call writers or the resistance in the market might fade away, and we might inch towards a 16,800. Now, if the reason we have positive bias in the market for another 5 to 800 odd points, so we believe that there would be certain stocks which would outperform or help the Nifty to run. We all know that the financial percentage of the stocks that we have in the Nifty contributes around 34%. The Fin Nifty, which was introduced a couple of years before, has an addition of HDFC Limited as well. So what we're trying to say is we like stocks like HDFC Limited, ICICI Bank, ITC, Tata Motors, and Tata Consumer, along with SBI Life. We believe that we have seen additional positioning of long side into these stocks. So this would be the stocks which can outperform and help the Nifty rally all the way from this so-called 16,100 towards a target of 16,800. So simply saying, the view on the Nifty or the index, at least on the Nifty side, if I might underline it, is we expect the Nifty to go towards a 16,800 with 16,000 as a base that we might have for this month of June. To primarily for two reasons. One is we have seen increased participation, and needless to say, when we see the participation go up, the broad-based buying usually comes into a week or so. So we are expecting stocks like ICICI, ITC, Tata Motors, Consumers, Tata Consumers, and SBI Life to be the one to help the Nifty inch towards 16,800. Now, especially there are a lot of option sellers into this market. So what they need to do is we need to understand two concepts. One is the volatility index is somewhere close to 21%. So we are expecting that to be around 16, 17% on the downside. And the upside, we do not expect it to breach the 25%. So if you look at this distribution that we have seen the highest seller. If you see this red bar, this is where the maximum amount of put writing is, and that goes with the strike. This is the monthly expiry strike, which is your 30th June. So 15,500 as a strike, where huge amount of put writers are still stable, and they have sold a lot of put option there. That goes with the accumulation of 17,000 strike for the Nifty call. So roughly this 1500 odd points is where at least the option writers have seen to be building the position for June series. And now why? Because we are at 16,200 to 250, there is a good 600, 800 odd points which might come in.
Manoj,
Yeah.
Manoj, can you go a bit slower? And also if you can increase your voice volume, because some of the participants are finding it low, and please go a bit slow. Thank you.
Yeah, thanks for that. Guys, I'll just go with the first part here. I hope my voice is audible, because I guess that's the max we have here. So first thing first, a simple way that we try to analyze or look into what the trend in the Nifty might be is to compare the position or the amount of Nifty futures that the traders have carried from May series to June series. So if we simply see the number, when we started the May series, the open interest for the Nifty futures was around 80 to 85 odd lakhs, so precisely around 85 lakhs here. And that has increased to 112 odd lakhs when we started this day early morning. So when we start the June series, today being the first day, the positions in the Nifty futures were an incremental of 25 odd lakhs. And because the Nifty has surged a good 350, 400 points from yesterday's low to almost 16,350 that we have seen today. So we believe that this could be long position. When I mean long position, this would be buy positions from the Nifty June series that we have seen. Now, obviously, because we are at 16,200 to 300, the objective that we have, the trend might continue, would be more towards a 16,800. The second reason why you think this might be possible, if you see 70 to 75% of the market volumes are from the derivative side, equity derivative side, if I might say that. And if you see the equity option side, there is good amount of delta trading which happens, and they are usually sellers of options. So the positions that are there in the market for the June series 30th, which is the end of June series, would be huge amount of put writing that you can see in this bar at 15,500, and that is followed with a huge amount of call writing at 17,000 strike. So if you see, even the quantum differs almost at 30-40%, but then yes, this is the highest open interest. So when you have a highest open interest as a strike, that usually becomes a resistance. So the view that we draw on the Nifty is we expect that the Nifty might inch all the way from this so-called 16,200 level that we are right now, 200, 250, to a good 16,800, to a good 600, 650 points. Even from the next week, we might get there. So just to underline, the reason would be incremental position and good amount of option positioning by the sellers or so-called writers of the options of the market. Now, in the event this unfolds and we come to a 16,800 to 16,900, if we may, there would be a couple of sectors and stock which might outperform. So of the 50 stocks that we have in the index Nifty, we believe that these 4 to 5 stocks are the one which can outperform. One would be HDFC Limited, followed by the banking stocks. One is HDFC Bank, ITC, Tata Motors, Tata Consumers, and SBI Life. So we have more details on this stock in the coming pages, so we'll let you know on that. So to conclude this first page, the bias is positive with a range of 16,000 as a stop loss, you might say that, and 16,800 as a target on the Nifty. Now, as we inch towards the second slide, this is the bank Nifty, and I guess this holds more important because at least in the last couple of years, we have seen good amount of options sellers have been there in this index. Needless to say, one, the premium is high, and the swing in this index usually gives the buyers and sellers almost the same opportunity to be in the trade. So simply comparing, I guess, as I said, in the May series, the Nifty corrected a good 6.5%, but the Bank Nifty showed excellent resilience, and the selling was not more than a 3.5%. So that concludes as an outperformance. So we expect that might continue into this June series as well. But if you see the position in the June series for Bank Nifty is lesser by almost 1 lakh. So the May started with a 25 odd lakhs. And for this month of June, we are almost at 24. Though today, end of the day, obviously, because the day has passed, the open interest has gone up and we might be at a 24 to 25 lakh as the Bow Puppy comes in. But if we simply compare how the expiry started, so short rollovers, which we had in the month of May, was not rolled into the June series. And that is exactly why we are seeing less positions of short. And that is showing as an open interest. Now, again, the option positioning, if you see the Bank Nifty index option positioning for this month, 33,000 as a strike has seen the highest put writing. If you see this bar here, and then the highest we have is around 39,000 for the call side, 35,000 if I'm not mistaken. Yeah, for around 39,000 strike we have. So this 400, this 4,000 odd points is where we expect that the next 32 days of June series might more or less move in. Now, because for stock specific, obviously we know the four major players, which is SBI, ICICI, HDFC, and Axis Bank. These almost contribute to around 84% of your Bank Nifty. And so almost a good 25 to 28% odd is what the average share is, if I may say that. So we believe that ICICI Bank, Kotak Bank, and Federal Bank, these are the three stocks that we believe there has been good positioning from the May series, which has rolled into the June series, and we are expecting these three stocks might outperform. Like in the previous slide, we mentioned that Nifty, there will be 5 stocks that can outperform. So for Bank Nifty and for traders, specifically for banking stocks, for this June series, ICICI Bank, Kotak, and Federal might be the bank that can give you an alpha over your index. So what we are trying to say here is, if the Bank Nifty inches more towards a 37 to 38,000 odd, these would be the stocks which would be responsible, and we would see them gaining more momentum with respect to rest of the stocks in the index. So to underline about the index, two things, as you said, for the Nifty, the base is 16,000 and we are expecting 16,800. The first reason is participation, and we expect that would be long roads. For the Nifty, we have seen, for the Bank Nifty, I'm sorry, we have seen good short rollovers, and we're expecting stocks like ICICI, Kotak, and Federal Bank to top the list in terms of exuberance or maybe outperformance that we might see in this series of June. Coming to a third slide, now this snapshot, this tells exactly what happened in the entire series from May to June. So I'll go with this. If you see on this side, if you have simply mentioned all the sectors with the percentage rollovers. Now, the rollover percentage is the amount of position that a trader or a client has into the current month, and when the expiry approaches, the amount which is being carried to the next month. So let's say if a trader had around, if a stock like, let's say TCS has around 1 crore of open interest, and if almost 95 lakhs of that has been carried from May to June, we say that the rollovers has been about 95%. So usually sector specific, we have seen this. So on an average, 90 to 92% is where the sectors have rolled in. But as I said, we look into the net position that a new series or a new stock has, and that is how that helps us gain if there is a long build up. So textile, though the amount of stocks in F&O is hardly some, so we would, but still it's there, but we still negate that. Strength wise, I get FMCG as a sector for this series, along with realty and cement, and obviously the banking, like we said in the last slide, would be the three sectors that we expect might be outperforming. And there are a couple of stocks in these where we expect that there is good buying and long rollovers happen, so which might continue and give a good at least a 5 to 8% alpha is what we are expecting on these stocks. So obviously this slide also says where we have seen lowest rollover. The reasons can be a couple of them. One is, as I said, if there is a short position and if it is not carried, excuse me, then obviously the percentage comes down. Or second, if there is no clarity in the index, in the sector. If you remember, even for Nifty, when we started the May series, the positioning was very less. It was just 85 lakhs because the view was not clear, and the same might happen in the sector as well. So this is the most important thing I would say, that because when we see a positive positioning in the index, so these are the sectors where the overall broader market has seen additional long rollovers in the stock futures. So what it means is, in the entire automobile as a sector, we have seen a good 3% additional open interest from May series to June series. Similarly, if you see now, obviously telecom is hardly a couple of stocks, but then power and FMCG. So I still believe that FMCG is one which obviously marks the take in both the series or both the analysis that we do. So FMCG as a sector would be the one where we might see good amount of buying happening. So in the next slide, we are trying to get into more stock specific into these sectors, which might help us understand or maybe get a trade into the next series. So we have just mentioned a couple of stocks. We have 4 major picks as well, which comes to the next slide. So as a sector, almost as I said, 95% is roughly where we have seen the net amount of positioning, which has happened from the May to the June series. And the stock specific in media as a sector, I guess PVR as a stock at 1790 is where we find it is good buy, where the positioning can be taken on the long side. For cement, obviously, it would be Ambuja Cement. Needless to say, even we have a positional call on that. FMCG, as I was saying, the sector, obviously ITC, Dabur, and
Manoj, can you go a bit slow? A lot of people are saying that you're going too fast for their understanding. Can you go a bit slow, please? Thank you.
Yeah. Okay. So guys, I'll just go back on this slide before we come to the next slide. Well, ideally, this slide tells us where the amount or the additional amount of positions is being taken into these sectors, and which are the stocks into these sectors, which can help us get a rally or maybe go into the trend, because the base or the index view that we have is we expect the Nifty to inch more towards 16,800. So a good 4 to 6% move, if I might say that, which happens on the index. There would be sectors and stocks responsible for that. So of the amount of positions that is being taken into the June series, we top the list with automobile. If you can see here, now this is the difference, or if you see the percentage or the amount of positions which has been rolled from the May series and which has gone into the June series. So like I said, what it means is, if the client has a stock future position into the May series, and when you see that additional being squared off into the May and which is bought again into the June series, that would qualify as a rollover. So we believe that automobile as a sector has seen an additional around 3% more of position or fresh positions, if I might say that. So I know it might not be wrong to say that the total amount of stocks which were there in the automobile sector as the May series, we have seen 3% of more positioning or stock futures being bought into the June series. So coming to this, as I was saying, of the sectors in the FMCG as a sector, which is fast moving consumer goods, obviously, we like 3 stocks. One would be ITC. Obviously, we have mentioned more in detail into the next slide. So Dabur at 495 is a stock that we recommend can still be bought for an upside of 4 to 5%, followed with Britannia at 3490. And the third stock, as I said, would be ITC. Now, this is the alpha or the additional thing that we have seen, that automobile and FMCG, now these have seen more positioning, like I mentioned, the stock specific Apollo tires in the automobile sector Tata Motors, Maruti, to name a few where we have seen good buying. But then we believe that the additional alpha or the additional move or the outperformance might come more from this stock, which is Apollo Tyre. So the stock was muted in today's day, but we have seen good positioning at 206 to 28. So we expect that 212 also can be a good level to go long, and we're expecting targets close to around 228 to 232 on that. Now, the second stock in the automobile would be Maruti. This stock also, I guess, the good rollover from 77.80 to 78.20 levels has been going on. But though the stock has surpassed the 78.50 mark, we believe that there is more upside, and possibly levels of close to 8,000 to 8,060. 8060 is what might be possible for this stock as well. So now we'll be going to stock picks that we have. So we have basically boiled down to 4 to 5 stocks now, along with the sector. So I'll just hand it over to Gaurav, who will give you a view on this.
Yeah. Thank you, sir. Good afternoon, everyone. We all are here to discuss about rollover, the rollover that happened from the May series to the June series. So I'm here to give you a brief about the stock we have picked. We have 4 recommendations for the stock. The stocks which we are liking that can give a good move either up or down for the June expiry for in the June series. First, we have HDFC. We are talking about the HDFC. The stock has appreciated over 2 to 3% in the corrective markets with good long build-up of around 7% on a month-on-month basis. The longs has been rolled off at 94% compared to the 78% in the previous month. The fresh buying is seen at the VWAP of around 2180 to 2200. So we suggest to go long in HDFC in futures at the rate of 2250 to 2280 with stop loss of 2200 for target of 2450. Second, we have Hero MotoCorp. Auto sector has seen a good traction and the position have been rolled in the auto sector in majority of the stocks. We have suggested Maruti in the previous slide as well. We like Hero MotoCorp. The stock gained around 5% with respect to the previous expiry. With the long built up of 5.4%, the long get rolled around 94%. 2550 to 2600 should act as a good base for the stock for the June series. So we suggest buying Hero MotoCorp at the rate of 2650 to 26800 with stop loss of 2570 for target of 2800. Coming to the next slide, our third pick is that is of course also on the buy side. We have SBI Life. The stock has seen a rollover of 96%. The OI started for this fund at around 79 lakh as compared to 76 lakh in the previous month. That is a rise of somewhere around 4%. The script had made a good base formation at 1180 to 1200 levels. So we suggest to go long in SBI Life in the range of 1120 to 1125 with stop loss of 1085. I repeat 1085 for target of 1200. Our last and fourth pick is TCS. We have seen IT sector has been in correction or in the corrective bias throughout the expiry. It has seen a decent correction, and TCS has also seen a decline of nearly 10% with rise of good 12% open interest. So which itself suggests that shorts are also in the system in TCS along with its pack of IT sector. The shorts are seen to be rolled at around 94%. So we suggest to sell TCS futures at around 3250 to 3300 with stop loss of 3400 for target of 2900. So these are our 4 stock picks. We reiterate that buy HDFC from financials by Hero Motocorp, that is from auto sector, by SBI Life, and we are bearish on TCS Futures. That's all from my side. Handing over back to the Manoj.
Yeah, thanks, Gaurav. So I'll just rephrase what we just discussed here. If you see two sectors, one is we all know that metals as a sector and IT as a sector has seen more selling into this recent correction that the indices have done. So stock specific, as Judge Gaurav mentioned, we like four stocks. One would be HDFC Limited. Now, the rationale behind this is, we see the net amount of position which is there from the May to June series. And because of a positive surge in the stock price, we expect this long position which has happened to inch more towards the target of a 2415 HDFC Limited. As I was saying, automobile, we like two stocks. One would be Apollo Tyre, which we mentioned, and the second stock here would be Hero MotoCorp. So the stock looks good for a target of 2,800. SBI Life also has seen good buying. Even in today's trade, I guess the momentum was positive. So for traders looking for long positions into these stock, the target can be 1,200 with a stop loss of 1,085. Now, as I said, that because IT as a sector has still not seen maybe less selling, or maybe the outperformance or the underperformance has been more into metals and IT. We believe that shorting TCS still at these levels of 3,300 or with obviously a stop loss of 3,400 can yield results of around 2,900. So this is basically the four stocks that we expect can be done as a fresh trade into the series. Now, obviously on the index, the view that we have is we expect the Nifty to inch more from the 16,200 to 50 levels to a 16,800. And like everyone, or maybe option traders who understand this, volatility index, the VIX is of more importance to understand. So we expect that obviously when the Nifty rallies, the risk in the market comes down, and that is why we see the VIX usually coming down. So we expect the VIX might cool down to a 16 to a 17%. And in this way, a better strategy that we can do here is we would be buying the month end, which is your end of the series, 30th June expiry, 16,900 strike call option for around 120 rupees, and we'll buy a 30th June 15,300 put option also, along with a combination of 110 rupees. So the net premium that the buyer pays is around 230 rupees, which is 120 of the call option and 110 of the put option. So when you add these two, it comes to a net total of 230 rupees. The stop loss would be 130 rupees on that, and we expect a target of around 450 on that. So I'll just go through all the slides just to.
Manoj, can you explain that strategy once again?
Yeah. So guys, obviously we are looking more from the June end month end expiry. So 30th June, as I was saying, June is a big month in terms of number of days. We have about 32, 34 more days. So buying a 16,900 strike call option for the June end, which is your 30th June expiry, the price of the call option is somewhere close to 120 rupees. And we combine it by buying the same expiry, which is your month end, 30th June, 15,300 put option at 110 rupees. So when you buy both of these, the combination, the net premium that a buyer has to pay is 120 plus 110 rupees. So that comes to 230 rupees. And the stop loss would be 100 points on the downside at 130. And because we are expecting a movement, this time a positive movement into the Nifty more towards 16,800, we expect this combination of call and put option to go or move towards a 450 to 460, which would be the target on the index.
Manoj, Varun is asking a question that if we are expecting implied volatility to come down, then why are we buying Strangle? Because if IV will come down, then premium will reduce? Can you please answer him?
Yeah, Varun, this is a very good question, and I really appreciate the concern that we're seeing. The first thing that we need to understand is VIX projects the monthly swing. A swing can be a positive or a negative movement into the underlying, which is your Nifty, but that is for 30 days period. And even if the VIX comes down, that we are expecting it to come down to 17, we have still a good 20 to 15 more days before we see the premiums of this option coming down. So if I have to simply answer your question, when you take any expiry call or put option, any option that you take, when the current day is more than half of that, for example, if you take a weekly expiry call, you have 5 days or maybe a 5 trading days before the call expires. So if you are on the third day, which is half of that, or if you're on the third day, then that is when the premium starts fading if you are on the wrong side of the trade. So in this side, as I said, June is a big series. We have 30 to 33 days and we are not even in the 1st of June. So at least till 16th to 17th of June, this premium amount, which will reduce by the fall in the VIX, would be far lesser than the movement in the Nifty. That is, we are expecting the Nifty to move more towards a 16,800, and the fall in the VIX would be less hampering than the gain in the premium that we'll get from the Nifty. Does that answer the question?
Thanks, Manoj.
Yeah. So I just put a couple of things, guys. This is just, obviously we are all here to understand more derivatives. So anytime, even on the weekly expiry, whenever you get into a weekly expiry on Tuesday, the reason is Tuesday is the half of the week when you start, like after we have weekly expiries on Thursday as well. So when you buy any premium post Thursday, and once the target or the view is not right till Tuesday, which is the next 2 days, that is when the option premium starts coming down. So a simple way to get out of all this calculation and to understand is a buyer of an option, the best time or the best strike to buy is if I'm buying it on a Tuesday or post a Tuesday, I would not buy the immediate expiry, which is in the next 2 days. I would go for a next week expiry. So this is one simple way where you can avoid this calculation. So always a buyer of an option, if it is Tuesday of the current expiry, avoid that expiry, go for the next week expiry. In this way, the VIX will give you 5 more days before the time decay starts. So that's a simpler way of maybe engaging the money into a positive side. So I was just saying we will, I'll just go through the entire thing because whatever discussed here goes for the next 32 days, especially the first 15 days, because see, derivatives being a dynamic type of analysis, the amount of interpretation of data, if that changes in the next 8-10 days, obviously there is a slight change in the view. So in this first slide, we explain that why we like Nifty, and the first reason is because we believe that this additional 25 lakhs which has been seen from in the June series versus the May series we believe it is long built up, and the average is around 16,000 to 16,100. So we believe that might not be breached and we might inch towards the 16,800. The reason 16,800 is because the month-end options, if you see the highest open interest on the call side, that is people who have sold call options, are at 17,000, and the protectors of the index towards the put writing is obviously a bit down towards 15,500. So if the Nifty goes to 16,800, if I'm not really trading into the index, the stocks that we feel can help gain momentum in the trade or an alpha would be HDFC Limited, ICICI Bank, Tata Motors, ITC, Tata Consumer, and SBI Life. The second slide explains that we are expecting an outperformance from the Bank Nifty, which did in the month of May. So we are expecting it would do the same, or at least be more towards the positive bias into the June series. So the stocks that we like, which can help the Bank Nifty do that, would be ICICI Bank, Kotak Bank, and Federal Bank. This does not mean that we are not expecting the other stocks to rally, but we expect that because these were the first stocks where cash buying and the long build up we have seen. So this would be the one which will maintain the momentum because we believe these stocks are already in momentum. And for the bank Nifty, the view that we have is 38,000 roughly on the index is where 37,500 to 38,000 roughly is where we'll have the underperformance. So, we might take the credit for that 36,000 strike call option that was given 4 days before when the market was wondering where to go. The premium was a good 80 odd rupees, and today at 250 rupees we have booked the profit. So that clearly says that this is that was the stage when we saw these stocks buying, obviously, but we wait for the rollover because this is a monthly trajectory thing and not really a weekly that we start buying it before the expiry. The third slide, which says about the increment, this would be the most important thing, because if the Nifty goes or inches more towards the 16,800, we need to see which are the sectors which is building a base and which might help to gain momentum. So obviously FMCG and automobiles, I guess this would be the two meaningful sectors. The rest, obviously there is a graph on that, but then the stocks and the weightage in the Nifty hardly matters. So as I said, FMCG, we like ITC, Dabur and Britannia. And in automobiles, we like Apollo Tires, Hero MotoCorp, and Maruti. So here we have mentioned the 4 stocks, which can still be bought on Monday. Obviously, the levels would differ a bit, but obviously when you look at the risk reward, see the initiating is almost at 2280 and the target is way towards a 2450. So the stop loss of 80 odd rupees and a good 130, 140 odd points, so the risk reward is more than 2:1. So even on Monday, if the trade is being initiated, we believe that 2450 should be a level where the profits can be booked into the June series. Same, the second stock was Hero MotoCorp. Obviously, as I said, in the automobile sector, it is Apollo Tires and Hero Moto, where we believe that there is good buying and we might see targets of 2,800 on the stock. SBI Life is one where we have seen good buying, especially since Tuesday, if I may say that. That is the second T-2 to expiry. That is 2 days before expiry. So SBI Life also, the momentum is good enough and we are expecting the stock to hover around 1,200, which would be the target. Now, the two sectors which have been seeing good amount of selling more, if I might say, one is the metals as a sector and second is IT. So we still believe TCS can be sold, or you can short the June futures closer to 3,300. Stop loss has to be at 3,400 and we are expecting around 2,900 in that. And the safest monthly strategy for the index, which is your Nifty, which we advocate doing even on Monday, the advantage would be there is a possibility, as like Varun asked me the question that why are we buying in a call and put option when we expect the VIX to come down. So these 2 days, which is Saturday and Sunday, even though the net premium is around 230 to 235, we might get it closer to 220 rupees. So the strategy that we suggest is go ahead and buy the month end, which is 30th June, 16,900 strike for the Nifty. The call option is around 120, and you combine it with the 15,300 put option at 110 rupees. The net premium you pay would be around 200 to 230. Stop loss of 100 rupees down, which is 130, and we're expecting a target of 450 under. So I guess this underlines the basic monthly rules and the strategy for the index sector and the stock. So if we have any queries, obviously we can go over with that. So Suraj, if you could take it over from here and we can see answer some queries here. Yeah, over to you, Suraj.
Thanks, Manoj.
Yeah.
I would like to request all the participants, if you have any questions, I request you to type it in the Q&A section so that we can address your query. Manoj, there is one question for you.
Yeah.
Or we can buy 16,200 PE and futures side by side.
Yeah, so I guess this is one strategy which can be done. But see, there are certain basics that a trader looks into when he selects the instrument for buying. When I'm saying instrument, it is either your index future, stock future, or your stock option or index option. Now, what happens is we all know that the swing or the amount of gap up and gap downs that we have in the market in the last 4 to 5 days, I guess this is the highest, maybe, at least in the last 4 to 5 years that we have seen. So 400 to 300 points is just a basic up and down that we have seen in the last month. So if you have a futures, obviously you are combining it with a put option. The M2M in the futures is usually higher than an option. If I might say, it is double of that. So once you buy a future at 16,200 or 250 level and you combine with the put, yes, that can be done, but obviously we'll have to have a good M2M stop loss, because let's say a gap down of 100 points, the put option might increase by just 50 rupees, and the Nifty futures long that you have might give you a negative M2M of 120 to 130 rupees. So if that is a risk which the client is willing to take, yes, that can be bought. The stop loss in this trade would be 16,000, and again 16,800 as a target.
Well, thank you, Manoj. Before proceeding further, we would like to request to hear from you. We are just going to flash a feedback survey. Just a couple of questions to help us to, So all the participants are requested to share your valuable feedback. That's amazing. We are going to close this feedback shortly. So all the participants are requested to share your valuable feedback with us. In a couple of seconds, we are going to close down the feedback. All the participants are requested to share your valuable feedback. So thank you, participants, for your valuable feedback. We're going to end this poll right away, and we will pick up the questions shortly. So Manoj, there's a next question.
Right.
What does rising OI means?
Okay. I guess a couple of
Very basic questions, I believe.
Yeah, but a couple of statements. So it is just what is a nomenclature that the derivative team uses for open interest, and O stands for the open part, and I would be the interest. So an open interest in a short form is usually nomenclature as OI.
Perfect. Thank you, Manoj. We have got a next question from Mr. Raghavendra. Why we are not taking index synthetic trade if our direction is clear for upside or downside?
Correct. Now, the first thing is direction is clear for the upside and the downside. No, we are more biased in the upside. The reason why we have bought a put is, as I said, the gap up and the gap downs that we have nowadays are a good 3 to 400 odd points. And when we are entering into an index trade using synthetics, the amount of margin involved, because when you buy an option, all you need to pay is the premium. But when you are writing or when you're selling an option, so you would be needing, at least I guess if I'm not mistaken, as per the span that is going on, at least a good 70 to 80,000 as a margin for one lot. So that would not be really conducive, because we need to wait for a good 15 to 16 odd days, as I said, into the June series before we might see that. Obviously timing is impossible, but we're expecting the 16,800 to be there closer to a fortnight at least from here.
There are some basic questions which we need to answer.
Yeah.
Varun, rising OI doesn't mean anything unless and until you don't see with prices. There are 4 basic rules which you can read from anywhere. But only rising or falling OI doesn't mean anything. You have to see it along with prices. Then only you can make some meaningful interpretation out of it, on which you can form some opinion. So just OI doesn't mean anything. See it with prices. Yeah, sorry, go ahead, guys.
Yeah.
So the next questions come from Fred's. Question is, one of my client has 16,300 P. He bought at 160. So can he hold?
We will not take trade specific questions, but can we go to that question? How will we calculate put call ratio?
Perfect. Manoj, over to you.
Yeah. So the question, if I understand properly, is how do we calculate put call ratio, right? So as I said, 70% of the volume that happens more into the derivative, 75% is from the delta traders who are sellers of option. So what sellers ideally mean is when we have good amount of put strike open interest, twice as that as a call open interest on the same strike. For example, let's say the Nifty is at 16,000 and the put net total open interest is around 1 crore. That is the total positioning that we have on the 16,000 put option. And on the call side, if we see the total positioning is around 50 odd lakhs. So if you simply divide 1 crore by 50 lakh, that comes to a ratio of 2. So that is when we say the put call ratio is at 2. Now the implications, if you need to be more precise, you should be using put call ratio along with a combination of VIX. Because if you simply understand, just to say, 65% of the VIX calculation comes from at the money option. Now, at the money is where the Nifty is right now. So if the Nifty is at 16,000, the call and put options of 16,000 are called at the money options. So put call ratio of 2 means there is twice the amount of support that strike might get to the call. Same way on the upside, when there is twice the amount of, let's assume that 16,500 as a strike, there is a total open interest of 1 crore in terms of options, and the same strike, which is 16,500 put option, the amount of open interest is just 50 lakhs. So the ratio comes to 0.5. So generally, when we have twice the call sellers to a put seller, that is where the Nifty or the index takes a resistance. And on the flip side, when we have twice the put option open interest to the call buyer, generally that is the level where the Nifty might take a support, because the put call ratio has to be used in conjunction with couple of other indicators, because this would be one of the indicators. Yes, it is good enough, but combine it with VIX, because what we see is a falling VIX necessarily says that the options are being sold. So in today's trade also, if you see the 21.2 odd was where we saw the VIX, and it was a good down by almost 4 to 3%. And we had seen good amount of put writing in 16,200 strike. So just to give an example.
Thanks, Manoj. We have got a very interesting question from Deepa Chopra. So the question is, please explain how do we calculate stop loss when you take long strangle? Do we need to put it on the day of month end expiry?
Okay. Now, obviously, a lot of traders or option buyers feel that there would be some sophisticated software to understand. But I guess the simple way to understand this is, when you buy any option, be it a call or put option, just simply divide it with the number of days you have for the expiry. So in this case, that we have bought the call and put option, let's say for 250 rupees, and we have a good 30 odd days. So almost 7.5 to 8 rupees, so that would be the amount by which the option would come down, or the premium would come down. So if you can use these simple ways, obviously there are precise ways where we look into the net, something called as a delta. Delta is the amount by which the option moves. So a simple way, whenever you buy an option, just see how many days are there for expiry. Your premium, you divide it with the number of days, and the amount by which it reduces per day, that should be your stop loss. Obviously, as I said, if you have heard this, after Tuesday or on Tuesday, it is better to buy the next week expiry exactly for this reason, because usually, let's say on Tuesdays, let's suppose today's Tuesday and we are at 16,000 Nifty. So if I buy a 16,100 call option for maybe a 30 odd rupees, and if the Nifty does not really go beyond a 16,100 in the next 2 days, even though I'm right on the movement of the Nifty, I end up losing money because that 30 rupees is going to become zero. So to answer your question, simply divide your premium, whatever is the call or the put option, to the number of days that you have for the expiry, and the answer that you get should be the stop loss for the trade that you have on the long side.
So basically, the stop loss for any such strategies are not just price wise. There are two types of, or probably three types of stop losses. One stop loss can be on the premium. One stop loss can be on the underlying. That if Nifty only goes above or below certain level, then I'll move out. The third kind of stop loss would be time-based stop loss. So because the expiry is of limited period, it's not like stock that you can continue to hold on to any period of time. There are different ways of putting stop losses. So it's not just price stop loss, it is also time stop loss, which you have to put in futures and option strategies. Thank you.
Absolutely. Yeah.
Okay, fantastic. So after this wonderful insight, Manoj, we have got another fantastic question from Mr. B.R. Santosh. So he's asking, what effects on market for PCR?
Sorry, what effects?
What effects on market for PCR?
So basically, Manoj is trying to ask how to interpret PCR and how does it impact market.
Okay. So if I might take one more minute, this is a very beautiful thing we need to understand, which almost 90% of people don't really understand. Except from a retail participant, when we have qualified FIs or P-note guys, the way they enter the index is, let's say they need to buy 1 lakh Nifty futures. So they're not seriously going and buying it on the screen. The first thing they would do is they would start selling half of the put quantity what they want to buy. So this implication means that whenever we see the amount of put selling in a strike going up to the call selling, that usually becomes a level where we have seen some buying. So to answer your question, your put call ratio on any strike, the importance here is it has to be on the same strike that you check. For example, if it is 16,000 strike, you check the 16,000 strike call and put option for the same expiry. And if the put is twice that as call, there is a possibility that strike will act as a support. And the upside, if the call is twice, the net open interest of the call option is twice as that of put option, that might act as a resistance. Yeah, Surat, I guess that answers.
Yeah, sure. Thank you. Yeah. So next question is basically from Mr. Just a moment, I just missed out the name.
So Krishna is asking that why are you buying out of money options? Means when you are saying the range is 16,000, 16,800,
right?
Then why are you buying 16,900 put and 15,300 put and 16,900?
Correct. See, I'll tell you, whenever we design a strategy, there are three things that we see. Now, first and the prima facie thing is the money involved. Obviously, if the amount of money a client or a trader has more, he can simply buy the futures, and the stop losses can be zero. He can just wait forever. Now, obviously, when it comes to a practical side, the first thing that we see is whenever you have a view on the index or an underlying or a stock, the target that you have, if you have an option which is near to that target, there is something called as a gamma. Gamma is nothing but the amount by which your option premium would increase or decrease as you approach. Let's say in this case, the target that we have is 16,800 and the strike is more or less towards that. So because June is a big month, if the Nifty inches towards a 16,600 also, the amount by which the call premium of 16,800 would increase would be more than what the 15,300 put will decrease. So to answer your question, why am I buying an out of the money call option? because the Nifty has been in a range of 4 to 500 odd point, and I expect the range to be breached. So whenever the range breaks, this time maybe on the upside, the amount of premium that I'll get in the call option would be far more than what I might lose in the put option. Yeah, that answers the question.
Fantastic. So participants, if you have any further questions, you can simply, type in a Q&A section. So we have recently received one question from Mr. Pankaj. I have basic questions of how do we calculate profit and loss. Say I bought one lot of 80 premium. On that day, it becomes 75, and next day I sold it at 85.
Mm-hmm.
How do you calculate the profit and loss?
So the simple maths that we are taught is basically the initiation point. That is, in this example, you said you have bought the underlying or an option or an instrument at 80 rupees, 80, and even though it has gone down to 75, when you square it off, when you sold it, it was 85. So obviously your profit is 5 rupees on that. The swing is 15 on 10 rupees. That is a different question. So your profit would be bought at 80, sold at 85. So that it's a profit of 5 rupees into obviously the quantity or contract what you bought minus brokerage charges.
Okay, fantastic. So we have got another question from Mr. Mohammed Saifi.
Mm-hmm.
Can we make short PE spread if we are bullish?
Yeah, this is a good thing. If I have to simply answer, the amount you will make by selling put option at a VIX of 21 would be more than what you would get really by buying at the money. Now, obviously, the strikes differ. It cannot be that you sell 1,000 point that the Nifty is at 16,200. If you're selling a 15,000 below, you're not going to really get money. Yes, you can sell this, but only after the Nifty closes above the day you get 16,400 and above close. Then you can start selling or writing, as we call in this language, 16,000 and below strikes put options.
I hope, Mr. Saifi, that address your query. Okay, perfectly fine. So if you have any questions, you can simply type in a Q&A section. 5 minutes more, that's it. So Manoj, I believe that we have addressed all the questions that we have received during the sessions.
Wonderful.
Right? So if you would like to say any final comments.
Yeah, so I thank all the participants to be here, spending that time here. And the major rationale that we have is this time that you spend here today after the market is closed will yield you more returns, or there is we are trying to help in understanding a trade or maybe a sector that might be allocated on the long side eventually in the coming days. Obviously, everything happens with a stop loss because this is market and nothing can be predicted as of 100%. So this type of analysis, especially from the derivative side in terms of positioning and the couple of sectors and the weeks that we discussed, if that is utilized, obviously it will help in gaining more alpha or returns or M2M depending on the instrument. So we will have this every month. And if you remember last month when we started this for the first time, we were bearish at 17,200 level in the Nifty. Gave us a good correction of 1,000 odd points, though we were bearish for 500 odd points, but still the direction was right and the rationale has gone in well. So try to continue this rationale, because the price in the derivative market can be a gimmick. It can take you to heights and maybe put you down to lower level. But if you follow these data, that can help you be more stable and gain more out of derivatives, which is a good instrument, but it can hamper losses as well. So I guess this should be the closing note that we have.
Perfectly fine. Thank you, Manoj, for this wonderful insight.
Thank you so much.
We would like to thank you all the participants for your active participation during the session. If you have any queries after the session, you may simply mark a mail to research@religare.com. With this note, we conclude this call. Thank you once again for joining with us. Have a great weekend. Take care. Bye-bye.